On All About Stocks this week, volatile trade on Dalal Street and the markets end flat. We'll tell you what your investment strategy should be. Paras Etanwala tells you why you should invest in Dhanuka Agritech and Ajanta Pharma for the long term. And we'll review Paras's own portfolio and tell you how he managed to beat the Nifty by over 12%. Welcome to All About Stocks. You're watching ET Now. Thank you so much for joining us. Now, it was a choppy week for the markets. The Nifty dipped below 6,000 in the first half of the week, and in the second half, it began to recover a little bit. We're going to try and find out how much more volatility we can expect from our markets and how we expect the market to play out as we approach our general elections this year. Remember, our email ID is at the bottom of your screen. You can send in any question you have about your stocks. Let me bring in Ajay for a quick update on how the markets panned out and who the big performers were, if any. Ajay, take us through what happened.
Well, Faith, this time around, this week, the market was pretty ordinary, very range-bound trade. No big gains or big losses made on the benchmark indices. In fact, the benchmarks were down about 0.5%. And in fact, Nifty traded in a very narrow range of about 130 points short this entire week, with bouts of weakness coming in. But every time market slipped, it rebounded very sharply from the 200-day moving average and finally settled above the 6,000 marks. In fact, 6,050 mark was pretty nicely protected. So there is something to take solace from, that we are not outright breaking down from the market. Also interesting that broader markets are coming back in a selective fashion. We saw the broader market indices gaining about 1% this particular week. If we talk of the complexion of the market, the fund flows remained very mixed from the DII and the FI community. In fact, we saw some participation coming back from the banking stocks, which was also something to take heart from, because this was one area of the market which was completely breaking down before in the earlier weeks. IT was another big area which was quite active in trade. Both sides, there was big movement coming in. Tech Mahindra triggered buying in some of the large cap stocks. At the same time, some amount of weakness coming in after Cognizant sent out a slightly lower than estimated numbers and a weak guidance. However, something which indicates that retail participation and HNI participation is not completely dried up is selective buying in mid-cap side of the market. Third quarter earnings are gradually winding up, and this week was a fairly in-line kind of numbers coming in with a positive bias, and markets are taking each number very individually, punishing the ones with bad performance and rewarding the ones with incremental good news coming in the internals. And also one big area was the global cues. In fact, emerging market currency as a basket stabilized this particular week, by which we also benefited, and hence the equities got a lot of support. Going forward, of course, the last week of big earnings, SBI, Tata Motors, several of them, a lot of banks will be coming out, which market would be reading for direction. And apart from that, the GDP number is something which market will react to and will absorb and take direction from for the next week.
All right, Ajay, thank you for that update. Joining us today, Paras Etanwala, Managing Director and Principal Portfolio Manager at Capital Portfolio Advisors. Paras, thank you so much for joining us. We've been talking about the volatility, and of course, there's so much uncertainty, whether it's about, the cues coming in from the global markets, whether it's our own political scenario. Should we expect more volatility in the rest of the months to come? Should we buckle down and get ready for it?
I would presume so. I think while, yes, we've been hearing about the taper for a long time, but the impact of taper, let me say initial impact, has already begun to be felt by several emerging markets. And if the more vulnerable economies continue to face problems and see tremendous weakness in the currencies, I think that could have some cascading impact in currencies across the world. And to that extent, we could see some impact on capital markets as well.
Well, I want to understand from you this. Now, we've read in the papers that the finance minister probably has the deficit under control, but it's also very likely that we'll see a lower GDP number also going forward. What does this mean for those of us who are holding long-term stocks? And what does this mean for our consumer-specific stocks?
I think when we are talking about long-term investment, we shouldn't be really concerned about what can really happen to the Indian economy in the next 3 to 6 months. I think we should definitely see moderate growth in the Indian economy, and despite the fact that the economy, the fiscal deficit and the other deficits would be in control. So I think that could have a sentimental impact on the stock markets in the very short term. But over the longer term, I think India should really embark back on its growth trajectory.
Well, Paras, since we're talking about the consumer stocks anyways, and we also saw that massive auto expo happen in Delhi this week, and the auto sector, let's be honest, has had a rough year. Do you believe that maybe those numbers will start turning around? There sounds like a lot of optimism from the auto sector. Within the auto stocks there, do you see anything promising among those launches that might affect one of those stocks?
Yeah, I think let's accept the fact that nothing goes on forever, and even the bad times need to really end someday. And my sense is that we are very close to the nadir rather than seeing further depths. And over the next 6 to 9 months, we should certainly see some kind of an impact or beneficial impact of whatever the auto industry has done in terms of cost cutting and the demand kind of recovering very soon. So it would be a very good time to really be start looking at some of the automobile stocks. And I would definitely look at Tata Motors being the top pick because not only do they have the passenger car segment, but they also have a dominant share in the CV segment. And the JLR business continues to do very well. So I think my top pick would be Tata Motors, followed by Maruti in the four-wheeler segment. And in the two-wheeler segment, I think one should definitely look at Bajaj Auto and Hero Motors.
All right, Paras, before we wrap up this conversation, I want your very quick word of advice for our viewers. You did say we're going to expect volatility. You also said that as long-term investors, we shouldn't be so worried about the next 3 to 6 months. So tell us what our strategy should be now approaching these elections. Should we now just, keep the portfolios that we have? Should we be pruning those portfolios, adding to it? What would you like us to do?
I think it would be a very good time to really be cherry-picking into the stocks that we like. My sense is that over the next 3 to 6 months, the bias of the markets would be slightly weakish, and any dip in the market should be used to keep on buying into stocks that you like. And my suggestion would be do not buy stocks in one shot. Keep on buying on every dip in the market gradually, and that will ensure that over the next 6 months you will have a very good cost of purchase for the stocks that you like.
All right, keep buying at dips. And of course, you remember Paras did name a few auto stocks that he thought were interesting at this point. He has a few more recommendations for us. We'll get to that in a little while. We have a question from Mangesh. Paras, he wants to buy PTC India, Punj Lloyd, Tata Power and Dabur India at these current levels. Now, he says he has an investment horizon of 10 years, which is always heartening to hear on a show like this. He wants to know what percentage of his total investment should be allotted to each of these stocks at these levels right now. First of all, would you like him to buy those stocks at these current levels, or like you recommended, buy at dips going forward?
I think of all the 4 stocks that he mentioned, the only stock that I like is Dabur India, for the simple reason that if India keeps on growing, so would the consumption story. And to that extent, Dabur would be the biggest beneficiary out of all the 4 stocks that he mentioned. I'm not at all positive on the generation companies, on someone like Punj Lloyd, because I think there are a lot of structural issues and company-specific issues. And the PTC India is essentially a trader's delight. It's a trading company in electricity and also is a trader's delight on the stock markets. So I think it would be very good on his part to really buy into Dabur with a 10-year horizon. And I'm sure that investment should give him very good returns.
We have time to take a viewer portfolio. Now, Vangeshwar has written in. He's our lucky viewer this week. We're going to look at his entire portfolio. Let's start on the top. 200 shares of Canara Bank, which he bought at 260 rupees. Now, Canara Bank ended the week at 220. But there's so much concern right now within the entire PSU sector about their NPAs. Would you recommend he holds on to Canara Bank?
Oh, absolutely. I think this is not the level to be selling out. I think this is the time to be buying selectively into PSU banks. And Canara Bank is, one of the largest, among the largest PSU banks. The valuations are very, very cheap. And as the economy recovers, all the concerns about NPAs will recede. And to that extent, I think the recovery in PSU banks will be far faster than that in the private sector banks.
All right. He also has 175 shares of NTPC, which he bought at 134 rupees. NTPC involved in that power tussle right now in Delhi as well. What would you recommend he does with NTPC? Hold on to it?
Again, NTPC, being a power generator and a government-owned company, I would suggest one should really exit and get into something which is a better growth story as compared to NTPC.
But he also has 50 shares of Coal India. It has largely similar problems. It is the monopoly in its particular sector, but it hasn't been able to translate that into shareholder value. Does it make sense to hold on to Coal India?
It's a similar story like NTPC. NTPC is also the largest power generator. Coal India is the only coal mining company in the country and has huge resources. But just because of the way it is managed, I think it will be unlikely to see some kind of value unlocking happening. I wouldn't really want to invest in Coal India at the current levels.
And finally, 110 shares of Heritage Foods, which he bought at 231 rupees. What's your call on this stock, Paras?
I think the company has been doing a good job of late. My suggestion would be to hold on to the stock.
All right, hold on to that stock. Now, if you'd like us to take a look at your portfolio, write to us. Our email ID is at the bottom of your screen. Welcome back. You're watching All About Stocks on ET Now. Thank you for staying with us. Paras Edenwala is still with us, helping us figure out our long-term investment strategy for our portfolios. Now, Paras has been kind enough to pick out two stocks for us this week, the first of which is Dhanuka Agritech. Now, Dhanuka Agritech manufactures a wide range of agrochemicals, and we've seen that its Q3 net profit rose by 82%. And if you pull up that chart for the last 52 weeks, you'll see how that stock has run away. Really. Paras, tell us why this stock makes your list and what you expect from it over the next 3 years.
As you put it, this is among the leading agrochemical companies in the country. But what makes it different as compared to other agrochemical guys is the fact that it is a purely India-centric agrochemical company so far. It imports from some of its collaborators like Mitsui, Sumitomo, Bayer, and sells it into the country. And it does not export, unlike other guys. The company has been very consistent in its growth profile. It is into the insecticide segment. It is also into herbicides and fungicides, and is gradually getting into more value-added molecules. The company has a very good distribution network across the country and has seen upward moving trajectory in terms of the operating margins. The company for the last quarter notched up a top line of 20% and a bottom line of 82% and is almost debt-free. It also has among the best return on capital investment, or return on capital employed in the industry. So my sense is for a company which is expected to grow at anything around 25% over the next 3 years, 25% per annum, giving a valuation of about 8 times probably is not justified. So I certainly would expect around 40 to 50% return over the next 1 year.
All right, 40 to 50% over the next 1 year. That was the first recommendation from Paras. Remember, he said Dhanuka Agritech. The next recommendation is Ajanta Pharma. Now, Ajanta Pharma is a specialty pharmaceutical company focused on ophthalmology, dermatology, and cardiology segments. Let's look at its Q3 numbers. Net profit was up 92% on higher exports. Paras, tell us what your expectations are from this stock over the next few years.
First, I'm sorry, I forgot to give a disclaimer that I do have interest in both Dhanuka and Ajanta Pharma. Ajanta Pharma is among the fastest growing pharmaceutical companies in the country. It focuses on the chronic ailments as compared to those anti-infectives. And it is also increasingly focusing on exports. Over the last few years, the contribution of exports to the total turnover has only been increasing. And to that extent, any depreciation in the rupee has only been declining, tends to benefit Ajanta Pharma. As of the last quarter, almost 65% of its sales came in from exports. And it notched up an operating margin of close to 32%, which is among the highest in the industry, probably the second highest after Sun Pharma in the pharmaceutical business. The company, in my view, should keep on growing at about 25% over the next 3 years with a rising contribution from exports and even the domestic franchise, kind of growing far higher than the market rate. For again 25% growth over the next 3 years per annum, with a margin trajectory which is expected to be at least maintained at the current levels, with better return on capital employed, almost a debt-free status, consistent dividend-paying track record. I think an 11 PE is at a close to 40 to 50% discount to the industry average, and to that extent, I think it certainly deserves a re-rating. So here again, I would expect a 40% return over the next 1 year.
All right, 40% return on that stock, and those are the two recommendations on your screen right now that Paras has brought for us this week. Let's answer a few more questions. Rahul has written in, Paras. He has 100 shares of JB Chemical, which he bought at 135 rupees, and 50 shares of Sun Pharma, which he bought at 615 rupees. He wants to know if he should hold on to both of these stocks. He's not losing any money. It's about par to his cost price right now. And we know that Sun Pharma is in your portfolio. What are you expecting from Sun Pharma from their results next week?
I think they should continue with a good show. The manner in which Taro Pharma has kind of turned around in Israel, the manner in which they are kind of growing in the local operations as well as exports. I think Sun Pharma continues to be a bewitching story. It is absolutely top quality stock in terms of the way the company is managed and the growth trajectory. Though the valuations are a little stretched, my sense is it will continue to gain strength even from the current levels. So recommendation would be a hold. And as far as JV Chemicals is concerned, this is a company which seems to be on the mend. After selling off its operations in Russia, I think the company clearly has a far better and robust balance sheet, is focusing on formulation as a local business as well as filing of ANDAs in the US markets. So I think the profile of the company has changed quite significantly, and to that extent we should see growth rates only getting augmented as we move along. The valuations are very cheap at about 9 times on FY15, so I think the recommendation is a hold even in JV Chemicals.
Right, Nandgopal has written in, he has 50 shares of L&T Finance at 80 rupees. He wants to know if we should hold on to that stock. Well, the net profit was down this quarter, Paras, but the company is so ambitious about its plans for the future. Does it make sense to hold on to it?
Yeah, absolutely. I think looking at the quality of management, and the kind of plans that have been laid out, it makes a lot of sense to kind of hold on to the stock. My sense is there is money to be made in this stock even from the current levels.
All right, so we hope that helps. Now, if you have a list of stocks you'd like us to take a look at, send it to us on the email ID at the bottom of your screen. Right, welcome back. You're watching All About Stocks on ET now. Thank you so much for staying with us. Paras Edenwala is helping us this week make money in the long term. And this is how we do it. Paras has a portfolio he's designed specifically for this show. This portfolio was designed on the 7th of December 2012. So far, it's made an overall gain of nearly 15%. Now, compare that to the Nifty, which over the same period is up about 2.5%. So, Paras has really managed to beat the Nifty handsomely. I'm going to give you a list of the stocks he's picked out for us. Axis Bank, TCS, L&T, Tata Motors, Sun Pharma, ING Vysya Bank, Tata Steel, Bajaj Finance, PVR, and Shobha Developers. Well, Paras, I want to ask you this straight off. We have Shobha Developers that's down about 26% since you bought it on this portfolio. Earlier in the show, you talked about how you'd like to stay away from the entire real estate sector. Tell us why there's an exception here for Shobha Developers. Why is it different from the rest of the sector?
Now, Shobha Developer, despite being in the real estate sector, has been able to weather the storm very successfully. And in addition, it has, some locational advantages, being primarily, out of Bangalore. Bangalore has been able to do much better in terms of the real estate market as compared to the rest of India. And the quality of management is also above board. I think if you look at the manner in which the company has been performing and compare it with other real estate guys, Shobha Developers definitely stands out, and it has a balance sheet which is kind of squeaky clean. So as the market turns and economy turns, my sense is Shobha Developers will also kind of stage a comeback, and therefore, despite the loss and despite the underperformance, I would continue to hold on to Shobha Developers.
All right, Paras, one very quick question. We have Tata Motors and Tata Steel in this portfolio. Both of those results are expected next week. Tell us what your expectations are from both of these companies.
Taking a cue from what ArcelorMittal has done and the outlook that it has given for the steel industry, it kind of confirms that probably we are at the bottom in the steel cycle, and the results that Tata Steel Europe should deliver probably will exceed what people expect. And if that really happens, coupled with robust financials of Tata Steel India, I think the numbers should be better than what people expect. And to that extent, we should see Tata Steel kind of doing very well, both fundamentally and therefore on the markets, over the next 2 to 3 years. As far as Tata Motors is concerned, I think it's very well known that the automobile market is not doing particularly well, and in the passenger vehicle segment, Tata Motors probably stands very low as compared to some of its illustrious peers. And therefore, one should not expect any great performance as far as the local operations are concerned. But JLR, from which it derives almost 70 to 80% of its profits and almost half of its turnover, should continue to kind of chug along very well. And to that extent, on a consolidated basis, Tata Motors numbers should also meet the expectations of people. So I think it makes a lot of sense to hold on to both the stocks. Having said that, I would like to make one change into the portfolio, that is of exiting ING Vysya Bank and including Motherson Sumi into the portfolio.
All right, can you tell us why you're making this change at this point?
Yeah. ING Vysya Bank is a very strong franchise. So while I continue to be positive on the bank, but if one looks at the growth trajectory, of ING Vysya Bank vis-a-vis Motherson Sumi, my sense is, the trajectory will be far higher in Motherson Sumi as compared to ING Vysya Bank. The simple rationale out there, Motherson Sumi is a play on the global automobile market. It's not a play only on India. It's not a play only on Europe, but it also a play on US. So if the economies of all these three places, they kind of improve, the delta in Motherson Sumi can be humongous. And it is not a one product company. It has several products, within its basket. So to that extent, it's a complete solutions, almost a complete solutions for the automobile industry. So I think looking at the quality of management, the growth profile, and the quality of balance sheet, my sense is Motherson Sumi should outperform ING Vysya Bank as we move along.
All right, so that's one change in Paras's portfolio. And to remind you, it's one of our most successful portfolios on this show. I'll give you a recap of the stocks in the portfolio. Axis Bank, TCS, L&T, Tata Motors, Sun Pharma, Motherson Sumi, Tata Steel, Bajaj Finance, PVR and Shobha Developers. If you have any questions about this specific portfolio or any of the advice that Paras gave us on the show, feel free to write to us and we'll ask him those questions when he comes back in the next time. Paras, thank you so much for spending time with us this weekend and answering all of our questions. We look forward to sitting down with you again very soon. Remember, a copy of the show is available on our Facebook page and you can reach me personally on Twitter. Thanks so much for watching.